one trade today on gold. It was a loss, and the worst part is it was completely my fault. Let me show you exactly what happened. Before our range is marked as usual, on the 5-minute chart, price pushes above the range high. The candle closed outside, so I'm watching. Next candle closes back inside, a textbook short signal. Then I checked the MACD. It was positive. For a short, that's usually a no. That's been a rule of mine for a long time. I don't short when the MACD is positive because momentum is still pointing upward. Sometimes I ignore the rule, but if you're a beginner trader and you're learning a strategy, I would highly advise against ignoring that rule. Most beginners remain profitable when they don't ignore the MACD. The setup might look clean, but the momentum disagrees. The rule exists for a reason. But the candles coming back inside the range had these big strong bodies. No upper wicks. They looked decisive. So in my head, I'm thinking buyers are stepping in hard. This thing is about to reverse and drop. I convinced myself that the price action was saying something that the MACD hadn't caught yet. So I went short anyway. Stop loss at the high of the breakout. Target at 2R as always. Price didn't drop. It pushed up. Tagged my stop. An almost $800 loss. And honestly, that's fair enough. So here's what I want to talk about. Candlesticks. Those big strong candlesticks I saw coming back inside the range, the ones that convinced me that buyers were stepping in, they were communicating something. They had large bodies, but no real wicks. On their own, that's bullish. And I saw it and I chose to ignore what it meant because I wanted to go short. I had been waiting for a trade for a little while, and when I saw the setup, I simply couldn't resist. You see, that's the thing about candlesticks. They're not random shapes. Every candle is a story about what buyers and sellers did during that particular time frame. So on a 5-minute chart, each 5-minute candle represents what the buyers and sellers did within 5 minutes, and so on and so forth with an hour chart, a 4-hour chart, a 15-minute chart. A big green body with no wicks means price opened and went straight up and didn't look back. That's the buyers in control. A long upper wick on a candle means price tried to go higher but got pushed back down. That's sellers rejecting the move. The candles are always talking. The question is whether you're actually listening or just hearing what you want to hear. Today I heard what I wanted to hear, and you can see the results. I looked at those bullish candles, and instead of reading them correctly, I reframed them to fit the trade that I already wanted to take. That's backwards. You read the chart first, then you decide, not the other way around. And that's exactly why I use the MACD as a filter, because it stops me from doing exactly what I did today, falling in love with my setup that isn't fully there. When the MACD says momentum is still up and the candles are pointing strong bullish bodies and my gut is saying short, 2 out of 3 of these things are saying the same thing. The market is still bullish. I should have listened. Losses like this one aren't really about the money. I mean, $800 is a real number, yeah, but the actual damage is if you learn the wrong lesson from it. The right lesson is I didn't use my strategy. By the way, if you're at the stage where you're looking to get started, the platform I trade on is called Xness. A link will be in the description below and in the pinned comment. It's clean and reliable, and you can open an account with as little as $10. The link will be down below. Always remember, the chart was never lying to me. I just stopped reading it.